Okay, so we will cover these in class, but I wanted to go ahead and record them so that you can refer back to them if you need to. So we're going to work on the calculations that go with the closings, lots of different calculations. So the first calculation that you might have to do is the broker commission. And we have to cut a check for the broker. May or may not be the same as the real estate agent, but it goes to the broker and then they pay the agent. So if we had a purchase price of $100,000 and a broker commission of 6%, the total commission that would be due would be $6,000. You just take the purchase price times the commission. We're going to be doing math, but it's simple math, addition, subtraction, multiplication, and division, but you have to have a good grasp of what is the ultimate figure you're trying to get to, and you also have to make sure you understand how percentages work. So if there happened to be two brokers who were splitting the commission evenly, then each broker would get $3,000, half of the $6,000. But it's not always a 50-50 split. It could be a 60-40. You just have to make sure that you have calculated it correctly. And if one of the brokers happens to be holding earnest money on behalf of one of the parties, then you have to reduce their commission by that amount that they're holding in in escrow. Prepaid interest. We talked about the fact that interest is paid in arrears. So if I purchase a house in December, I would not make my first house payment until February 1, and that would cover the interest for January. But if I closed in the middle of December, that means there's some days of interest that have not been covered, and we have to pay that at closing. It's called prepaid interest. So we have to determine how many days need to be collected for prepaid interest. So for example, if we were closing on September 14th, the borrower's first mortgage payment would not be due until November 1st, and that would cover the interest for October. So we have to pay at closing the interest from September 14th until September 30th. So we have to figure out how many days that is. We have to figure out what's the interest per day, and then we have to do those calculations. So if the interest per day was $23 and we closed on September 14th, remember that the day of closing goes to the buyer borrower, okay? And make sure you count those days. Don't just assume that you know how many days it is. If we actually closed on September 14th, it would be 17 days until the 30th. So there's 17 days of prepaid interest that we have to collect. We've been told that it's $23 per day. So multiply $23 times 17 days, and you get $391 that we have to collect in prepaid interest at the closing. So this next section deals with escrow. Escrow it's this separate, connected, basically bank account that you are funding each month. Part of your mortgage payment is going into this escrow account so that when your property taxes or your hazard insurance comes due, there will be enough money in that account to pay those bills. The lender will require you to escrow certain things. Usually they're doing this because they don't want, yeah, maybe you're making your mortgage payments every month, but then when the property taxes come due, you don't have the cash to pay those property taxes, and you end up getting a lien placed on the property for non-payment of taxes. So the lender says, okay, to avoid that, we're going to make you put a portion of your mortgage payment into this bank account each month so that there's enough money to pay the bill when it comes due. And so depending on what time of the year you close, you might not have enough money in there to pay the bill when it comes due. So the lender determines how much they want you to jumpstart that escrow account with, how many months of those fees, bills, do they want you to place into the escrow account at closing. And usually the lender is going to tell the attorney how many months to collect. And as we get through this presentation, we will do one of these calculations. Okay, so let's go back. Real estate tax prorations. Proration just means to divide or apportion. You have to look at the facts surrounding a particular real estate closing, determine when taxes are due and what the tax calendar or the tax year is. Most of the time it's the calendar year, January 1 to December 31st, but those taxes might be due usually at the end of the year, but sometimes November, beginning of December, but it's for the calendar year. Some places will have, some counties might have that the tax year is from June 1st to May 31st or July 1st to June 30th. And so that changes your calculations, but it's still the same process. So first you have to determine what is the tax year. Then you have to determine, have those taxes been paid yet by the seller? If they have been paid, then the buyer is going to have to reimburse the seller for the days that the buyer actually lives in the home for that tax year. If they've not been paid, then the seller is going to have to reimburse the buyer, because the buyer is going to have to pay the taxes when they come due, and the seller has to reimburse the buyer for the number of days that the seller lives in the house. Now you can prorate anything. You can prorate your homeowners association fees, city taxes, a utility bill. Anything can be prorated. So just keep that in mind, what that process is. So here's a tax proration that we do. Let's say that the property taxes due for the current year is $2,000. They are due on October 1st, and the closing occurs on November 15th. Tax year is the calendar year. The paralegal confirms that the seller has timely paid the property taxes, okay, in full, and so buyer's going to have to reimburse the seller for the taxes, okay? So if the taxes were $2,000 for the year, we're going to divide that by 365 days in the year. That means that the taxes per day the taxes on this property per day are $5.48. It was actually 5.479 and into infinity. Round it to $5.48 and always clear out your calculator. Don't do the next calculation based on that number that's going out into infinity, because your numbers will end up wrong. So the taxes have been paid, so we've got to reimburse the seller. The buyer owns the property from November 15th, which was the day of closing, until December 31st. So I'm going to figure out how many days that is. Count it up. It's 47 days. So then I'm going to take the per diem tax rate, the $5.48, and multiply it times 47 and get $257.56. That's how much the buyer owes the seller for the amount of time or days that the buyer lives in the home. Okay, because the seller's already paid the taxes. So here we have another tax proration, just a little different because of the timing. So the property tax for the year is $2,200. The taxes are due on November 15th. Okay. The closing happened on January 31st. The tax cycle was January 1 to December 31st. The paralegal confirms that the seller has not, and that's supposed to be paid the property taxes for the current tax cycle. It's January. They're not due until November. So why would they have paid it? They wouldn't have, okay? So okay, so here's how we do the calculation. The taxes were $2,200. We divide that by 365, and we find out that the per diem tax rate is $6.03. Every day that someone owns that piece of property, they owe $6.03 in property tax. Okay, so the taxes haven't been paid because they're not due until November. Why would the seller have paid them? They wouldn't. But the seller's got to reimburse the buyer for the time that he or she lives in the home prior to closing. Okay, so the seller owned the property from January 1 to January 30th, because remember, day of closing goes to the buyer. So January 31st is our day of closing. So we have to calculate how much tax the buyer needs to reimburse, the seller needs to reimburse the buyer for. It's 30 days times the per diem of $6.03. So $180.90 to reimburse the buyer. So he has that money when the taxes come due. Okay, we handle this reimbursement at the closing. Okay, as I said, you can prorate homeowners association fees. If there's a special assessment that's been done, maybe the county's putting in county water, they may have assessed each property owner a certain amount. You can prorate that. You can prorate utilities. You usually don't do that in a residential real estate closing, but you might do that in a commercial closing. Okay, so here we're going to work through doing all of these calculations. Our firm is handling a purchase and sale. The closing is scheduled for December 12th. The buyer is purchasing the home for $176,500. The seller has already paid the taxes, which were $2,487.45. They're due on December 15th. but he's already paid them. The tax year is a calendar year. The seller has contracted with the real estate agent for a 7% commission. The buyer has secured a loan for $155,000 at 4.25 interest rate. The lender is requiring the buyer to escrow 2 months of property taxes and 6 months of hazard insurance. Usually they would require the same number of months, but I'm just trying to give us some variation in our calculations. The hazard insurance is $965. And finally, the seller has already paid the Homeowners Association dues for December in the amount of $125. So we're being asked to calculate the following: the commission, the real estate commission, transfer tax, intangible tax, Homeowners Association dues, proration, prepaid interest, and then the escrow amounts for taxes and for hazard insurance. So each of the next slides is going to address each of these calculations. So the commission, that's the easiest one. If our purchase price is $176,500 and our agreed upon commission is 7%, you're just going to multiply the $176,500 times 0.07, which represents a 7% commission. So $12,355 is the real estate commission. Transfer tax, remember I said $1 per thousand of purchase price. That's just easier than doing the statutory calculation. So $176,500 is the purchase price. We divide that by 1,000 and we get $176.50 in transfer tax. Same basic calculation for intangible. It's just now that it's $3 per 1,000 of loan amount. So our loan amount was $155,000. Divide that by 1,000. You get 155. Multiply that times 3, and you get $465 of intangible tax. Remember, intangible tax is based on loan amount, and transfer tax is calculated based on purchase price. Tax proration. So the taxes were $2,487.45. They've been paid by the seller. We calculate our per diem, which is $365. $2,487.45 divided by 365. We get $6.81 per day in taxes. The buyer is living in the house 20 days. We're closing on the 12th. Day of closing goes to the buyer. 20 days remaining in December. Multiply that times the per diem of $6.81, and we get $136.20 that will be collected from the buyer and goes to the seller since they have already paid the taxes. Homeowners Association dues. It's only for a month, so we're figuring our proration based on a month. So $125 that the seller has already paid. There's 31 days in December, so we divide that into $125, and we get $4.03 per day of Homeowners Association dues. The buyer is going to live in the house 20 days of that month, so multiply that times the $4.03 per day, and we've got an $80.60 Homeowners Association dues proration. This is probably the most complex of the calculations, but it's not difficult. prepaid interest. Remember I said that interest is paid in arrears, so you have to, if you don't close on the last day of the month, you have got to figure out how much you owe in prepaid interest. So if our loan amount is $155, remember it would be calculated on loan amount, not purchase amount, and our interest rate is 4.25. We're going to multiply $155,000 times 0.0425. That's the interest rate. What means we have $6,587.50 is how much we're paying in interest for the year. We divide that by 365 and you get $18.05 per day of interest. Now, if we close on December, I think we're closing on December 12th. I have to go back and look at those facts. And we close on December 12th. That means that the first mortgage payment would not be due until February 1st. And it will cover the interest for the month of January. So we're dealing with those remaining days in December. Okay, so those 20 days we multiply time the per day interest, 1805 times 20 days. We're going to have to collect $361 in prepaid interest from the buyer at closing to cover those days in December. That's why in a real estate practice, we are extremely busy on the last couple of days of the month, because that means you have fewer days of prepaid interest that you have to pay up front at closing. Escrow. We had directions from the lender that we're collecting 2 months of taxes and 6 months of hazard insurance. So our taxes estimated for the year, $2,487.45. We know that's what they are for this year, but we're estimating it's going to be close to that for next year. So now we are working on a per month instead of a per day. So $2,487.45 divided by 12 months means $207.29 per month that we're going to have to have in order to pay our taxes when they come due. Bank says, the lender says you need to collect 2 months in advance. So multiply that $207.29 times 2 months. We're going to have to pay at closing $414.58 in order to fund the escrow account for property taxes. Same basic calculation for hazard insurance, just in our facts, we said that the lender had instructed to collect 6 months of hazard insurance. So $965 divided by 12 months is $80.42 per month. Multiply that times the 6 months. We're going to have to pay $482.52 to fund the escrow account for hazard insurance. So those are all the calculations that we're going to talk about, or we're going to cover. And keep in mind, most of this is done through some software program. Like I said last time, probably the most used is a program called LandTech. But if you know how to calculate this, by hand, not only can you verify that the computer program is calculating the correct amount, but also in case something goes down, you don't have it and you've got to do it by hand. So practice, practice, practice. And that's all this is. It's basic math. You don't have to do any advanced calculations, but just knowing how to come up with these figures, you can better understand if the system is calculating them correctly, and you can explain it to someone if you needed to. Okay, so practice, practice, practice.